Hello, welcome to Morris Money, where we give you stock tips in under 5 minutes. I'm your host, Morris Willie. Today, we're talking about one of my favorite long-term stocks, AGNC, and why you should be buying them with their high dividend yield. The highest yielding company on Motley Fool's 3 dividend stocks to buy was AGNC. Believe it or not, the company's nearly 9.8 yield is below its historic average. Over the past 13 years, AGNC has averaged a double-digit dividend yield for 12 of those years. Though the securities mortgage REITs own can sometimes be complex, their operating model is relatively straightforward. AGNC aims to borrow money at low short-term lending rates and use the capital to purchase high-yielding long-term assets, like mortgage-backed securities. The goal for the company is to maximize its net interest margin, which is determined by taking the average yield from its asset portfolio and subtracting it from the average borrowing rate. One reason for investors to be excited about AGNC is where we are headed in the economic growth cycle. It's common for the interest yield curve to steepen when coming out of a recession. This steepening involves the gap in yields between short-term and long-term treasury bonds widening. When this happens, AGNC typically sees its net interest margin increase. Something else that will be key for AGNC's success is the Federal Reserve's slow-stepping its monetary policy changes. Although higher lending rates should increase short-term borrowing rates, what AGNC is counting on is the nation's central banks outlining its policy proposal and sticking to that plan. As long as there's no big surprises, AGNC and its peers will have an ample time to adjust their portfolios to maximize profit. Investors will also note that $82 billion of the company's $84.1 billion investment portfolio are in agency securities. An agency asset is backed by the federal government and in the unlikely event of a default. This protection allows AGNC to develop leverage in order to increase its profit potential. Now, before you think about investing in AGNC, they just announced their fourth quarter report, so let me give you some of the highlights from the fourth quarter. They had a 31% comprehensive loss per common share, comprised of 75-cent net spread and dollar roll income per common share, excluding estimated catch-up premium, $15.75 in tangible net book value per common share as of December 31st, 2021, 36-cent dividends declared per common share for the fourth quarter, and a negative 1.8% economic return on tangible common equity for the quarter. Not the best thing you want to hear, but some interesting points nevertheless. Now, I'll leave the decision up to you. What do you want to do? Buy, sell, or maybe you're even holding Atlas? Let me know in the comments below. Please don't take this video as financial advice, and thank you for watching Morris Money.